Good evening, everybody. Welcome to Zoom at 8. My name is Julianne Peterson, and I am your host every Tuesday night for Zoom at 8. I'm also a loan officer for Old Capital Lending, and we are the premier provider of debt on mostly multifamily, but we'll do other asset classes. I just closed a medical building, so SBA loans. So if you're looking for a loan in commercial real estate, we can be your go-to lender on that. So, the markets are crazy. If you've been watching things, every day I open up my email and I've got a set of new deals that are available. Most of them are Class A deals. So we're going to talk about what's happening in the market today with Aleksy and really want to make sure that you understand when you're underwriting these deals, making sure that you come to us or a lender before you put in an LOI. Because what happens if you're underwriting this at 75% and the lender can only bring you 60%? If you put in that LOI with a way high purchase price, you may be shooting yourself in the foot. So I say make sure you check on the taxes, the insurance, and the property management before you come to a lender. And once you have those vetted, we'll turn a quote, especially if it's agency, in 45 or 48 hours. And we'll give you information like are the proceeds going to be once you win this deal. So I want to see a T12, a rent roll. Those are in Excel. I want to see your underwriting in Excel. And I want to see an OM if you have one. And we'll go ahead and send that off to our lenders and give you feedback. Like, what is up with the R&M? Is it high? If you're underwriting utilities, trying to reduce them, can't do that. Okay. So we are a great resource for that. We are here tonight to kind of give you some things to be thinking about. If you're an LP and you're looking for deals, how do you know who these people are? How do you vet them? So Aleksy Chernobelskiy he is an advisor of limited partners on existing and future investments. He's also the founder of GP LP Match. It's a platform that allows LPs to see deals that match their specific investment criteria right in their inbox immediately after the GP submits it. Aleksy also writes a weekly information to 6,000 investors. It's called lplessons.co. lplessons.co, and it explains how to properly vet and think about LP investments in the grand scheme of your portfolio. Aleksy also helps general partners on matters relating to LP, such as capital calls and feedback on investment decks. He's a principal at Centrio Capital Partners. Aleksy graduated from University of Arizona with a quadruple major. We have a smart guy in the room with finance, mathematics, economics, and accounting. So, boy, oh boy, an overachiever here tonight. Aleksy, welcome to Zoom at 8. So glad you're here. How are you tonight?
I'm doing great. I just sent some links. I feel like that was kind of a lot. In case it's helpful
Okay.
for people, I sent the newsletter, like where you can get deal flow, and also my LinkedIn in case you guys are on LinkedIn. Thank you so much for
Awesome.
having me.
Absolutely, absolutely. And I got to know you first through LinkedIn. Your information that you share is amazing. It's full of really rich comments and direction, and I think you are just have so much to offer a lot of people. And as well, you came to our Old Capital speaker series, and that was a virtual event. So thank you so much for joining us there. But I want to set the stage. I want to set the stage and tell us a little bit about you, Centrio, the GPLP match. Kind of let us get to know you a little bit more.
Yeah, sure. I mean, I guess in short, I came from the institutional world, so like a public real estate investment trust. And then at some point I left roughly 3 years ago. And I realized that this is like there's like a big GP LP universe that isn't so efficient. In other words, there's like GPs looking for LPs, LPs looking for GPs. Most people don't know each other. And also like the quality of the information changing hands any given moment is subpar. And so the first thing I set out to do is uh, so like I kind of roll back the curtain on what happens behind the scenes, how LPs should think about syndications, and that was really the intent behind LPLessons.co, which by the way, kind of crazy to say, but I just crossed 9,000 subscribers recently.
Wow,
I
that's
guess
a
I
big
sent you
deal.
like a old old stat, but um I write there weekly, and that's really meant to like educate people, both GPs and LPs, on kind of what I'm seeing in an anonymous way. Um, and at some point, I felt like I had like a big enough audience to help connect GPs, LPs, GPs and LPs. I do that for free. Like it's like totally free for a GP to post a deal, for LPs to receive deals. And yeah, I'm 2 months in. I think I shared deal number 99 recently. So I'll let you know what 100 is, or maybe you'll find
Wow.
out if you sign up. Um, and yeah, I'll open to like any questions, obviously, but yeah, that's a little bit
Yeah.
about me.
Well, fantastic. So you currently are investing yourself as a general partner or limited partner. Where do you play in this?
Yeah, so I get that question a lot. I would like to invest myself. The problem is there's sort of like a alignment issue. In other words, if you ask me to review a GP's deal, and then I tell you like, oh man, that's a rough one out there. I don't know if you should look at this one. And then I'm like, oh, by the way, I have this other deal that I'm looking to fundraise for. You want to invest in mine? Like obviously there's a massive conflict of interest. So as a result of that, I have not raised any money at all. I might in the future, but basically I think about those businesses independently. In other words, if I decide to raise money one day, which I might, that probably sort of shuts down my consulting business because it's just too conflicty for comfort.
Yeah. So let's kind of unpack that as well. So when somebody can utilize your services, somebody could bring you a deal that they're looking at and get your high level or even have you dig into that deal to say, does this make sense? Is this something that we should go after? Tell me more about that.
Yeah, exactly. So most of the work is someone sends me a deck on a future deal that they're looking at, so something that they want to invest in, and I give them feedback on that deck. Um, a decent amount of my work, especially in the past like 6 months, has also been on existing deals. So if an existing deal kind of went sideways, distress, foreclosure, capital calls of all sorts, in some cases like fraud. Like I've looked at a lot of those cases as well on behalf of LPs. And you know, I guess unfortunately that side of the business has sort of grown in the past year or so. Um, and yeah, th those are sort of like the most common ways to help people. And I guess most recently, especially as a result of GPLP match, like I have very interesting insights into sort of like what LPs prefer in syndications, right? Because they set filters on my website. I also have a lot of intel into like what GPs are offering on deals because I've sent 99 deals in the past 2 months. And so I guess I've realized like more and more GPs have reached out for feedback on market terms and like where LPs are in terms of market terms and things like that.
So let's talk about what you're finding on deals that people are bringing you from 2021, 2022, their current GPs. Are they coming to you for solutions? Are you looking at their deals saying, hey, we think we're at 85 to 90%, maybe even 95%. Where occupancy is great, but we just can't do any distributions. Are you seeing that? What is your response? Are you seeing that they're working with lenders? Kind of give us what you're seeing and what are you encouraging people to do?
Yeah, I mean, I see a lot of crazy stuff.
Crazy
So
stuff. I want to hear that. I want to hear more
yeah,
about that.
I mean, like on the one side, I'll hear a lot from LPs that'll just call me and say, "Hey, I got your number from so and so. Like, I'm invested in this deal," and they like stop distributions. I'm convinced that the whole thing is a fraud. And long story short, I don't want to bore you, but like, you ask a few questions, maybe, they engage me to give them some advice. And long story short, it's like, no, like I actually think the GP is doing the right decision by stopping distributions, and it's actually good for you. It's actually in the best interest of you as an LP to not get distributions. Otherwise, I mean, they could not stop distributions, but in a few months, you're going to get a capital call. So like, might as well plan accordingly, right? Which is good. On the other side, I also get cases that are like, I I got this email, like it seems like the property isn't doing well, seems a little weird. I start digging in, and there's like, for the lack of a better term, like a dumpster fire happening. And I mean, I just had a call today without disclosing any names on like one of
Give
my
us that case
engagement, like
study. Give us that
yeah,
case study.
like the FBI got involved, like
Ooh,
like and like like things. Um, Yeah, that's literally just a call today, like from this morning. So the there's there's a wide range.
a wide range. So, what do you
Oh
tell
yeah.
somebody that has the FBI coming in, talking to them? You're obviously talking to the LP that knows
Yeah,
about
I
the
was, yeah.
FBI coming in. So, what do you say to them about their deal? I mean, not much you can say, but I'd be curious
Well,
what
this
that
one was
looks
actually
like.
interesting because I guess you're catching me at an interesting time. I like I've like, litigated with an attorney, obviously. Like I've seen all types of cases and all types of like misrepresentation, securities fraud, all types of stuff, but I have not had a case where the FBI got involved until today. Um, so I think what I told him was, it's weird. Like on in some sense, this sucks, right? Because like any action you take legally is basically irrelevant. Meaning, as soon as the FBI sees assets, like like your legal letter is not going to scare the FBI, and the GP is like not even involved anymore, essentially. So like that's bad in a sense.
Yeah.
Um, but the good part is, one of the challenges of being an LP in a not so ethical GP, let's call it, is you have no control over like who they sell the property to. Did they really do their best job managing it? Did they do their best job selling it? Right. And so you can sort of tell them like, hey, I'm upset. Like it seems like you're not managing it right. And usually they'll just ignore you. And then at the end of the day, they might sell it to like their uncle, so to speak.
Mm.
I'm just using that as an
And
example, obviously.
recapitalize it with them in the deal.
Yeah, yeah, like they might sell it to someone and like, maybe not get the best price, but it was the easiest sale. And you won't get much for it in terms of, the 100 grand that you invested. You might get like a $5,000 check and an
Mm.
email talking about how like
Yikes.
difficult things are. Now, when a third party is involved and they basically like quite literally seized all your assets, which is wild to say. The good news is like you're probably going to get a fair dollar amount, whatever that dollar amount is. You might only get $25,000 of your $100,000 back, but at least you know that it was a fair $25,000. you know, it's yeah, it's a
So
wild
are you
time.
getting these calls on a daily basis then from GPs or LPs? What is your volume
So
in these
most of my calls come
conversations?
from LPs.
Okay.
Um, is it daily? I mean, it's about daily. Yeah.
Yeah.
Like I'm pretty public, like on LinkedIn and Twitter. Um, and like I'll hear from people many times that they don't want to engage me in any way, but they're just like, hey, I just want to let you know that I got this report. Looks strange. Do you know anything? And I sort of like try, I try to help whenever I can. Um, but yeah, like I guess things are heating up a little bit.
Heating up. Okay, so we thought that we would survive to 25. I don't know if anybody's surviving really as a limited partners. I think that they have a lot of things have been put on hold, no distributions. Uh, I mean, even our good deals that have agency on them, they're not doing distribution. So can you talk a little bit about what you're seeing across the nation? Are you seeing certain markets that are still doing distributions? Are you encouraging people to go to those certain markets? Give us your analysis of where we are today and where you think are we going to continue to survive in 25?
Yeah, I guess look, probably deeper conversation, but I don't really like those terms. Um because I just feel like they're meaningless. And I'll explain why. In other words,
It's a
it's
catchphrase
kind
though,
of
right?
actually I'll give you a very practical example. It's like opening up a deck from a GP, right? And you're thinking about investing, and on the second slide it says, I'm not whatever, third slide, fifth slide, whatever. I'm not pointing to anyone specific, but I can tell you that it happens all the time, and it says something along the lines of, "We've never lost investor money." So you're
Uh-huh.
like, "Oh, that's great." Or here's another one, like, "We've never done a capital call." Amazing.
Mm.
So an average LP looks at that and they say, wow, like you've never lost investor money, everyone else is. And you've never done a capital call. And I just keep seeing all these articles and like, posts on, whatever blog about capital calls. So like seems like a great sponsor. Now, behind the scenes and all half the time they invest, which bad idea, but not investment advice. Um, the reality of the situation is they're sitting on a bunch of paper losses, like half of their portfolio is
Ah,
wiped out and 2 months away from foreclosure, but they haven't lost investor money yet.
Not yet.
Not yet. Exactly. Oh, and the capital calls, they have never done a capital call to the LPs, but they're in the middle of a raise on a pref at 15 or 20% with a third party, and they didn't tell you about that because you're going to sit behind the pref, and that's also bad. That's even worse than you contributing the money and having that chance to contribute. So like there's a lot of these I guess phrases that I'm going to call them like marketing phrases,
sure.
right? Going back to your question in terms of surviving, similarly, I think one of the things that is very difficult for me in the space is people call me again all the time and they're like, my pref stopped. I'm so upset. And you do some research and you're just like, you should be glad that the pref stopped. The challenge all the time is, well, like I was depending on that money. Well,
Mm.
perhaps a different conversation, right? But while we're here, I would not recommend anyone to invest in any sort of investment where you're like depending on that dividend to survive or live. And I would always tell you to like think about um, only allocating a certain percentage of your net worth to alternative investments in general because they're risky and also illiquid. I don't know if that helps. Obviously, like I can go on for a while, but that is just some high level thoughts.
So, you did talk about other investments. So there are a lot of tired investors right now in multifamily. They haven't gotten their distributions. They got into multifamily as general partners. They thought that they were going to, you know, close many deals one after the other so they could get their acquisition fee. That's
Mhm.
not happening. Where are these people going? Are they going to alternative? And are people following them to the alternative, whether it's car washes or it's industrial? Should investors be following them? Okay, it didn't work in multifamily, but it might work in car washes or industrial, mobile home parks. Or do you think that they should stay in multifamily? Or do you think that these investors that were LPs in their deals should be looking for other investment alternative investments without that person? Kind of talk to us about
Yeah,
other investments, other alternative
yeah, yeah, yeah.
investments.
So I mean, I advise on all types of stuff.
Okay.
I would say more than 50% is not multifamily. Um, I guess here's where my head goes when you ask the question. I think one of the hardest parts about being an investor is being honest with yourself. And to be
Mm,
candid, a lot of LPs have a hard time with that. Like when a deal goes bad, naturally you just want to blame the GP and say like terrible person, liar, bought
mm,
something at ridiculous, dollar amounts, assumed ridiculous things and lost my money. I hope they get sued into oblivion or whatever, right? Um, and I think you could say that if you want, but but the biggest thing that's missing in that statement is like, what could you have done better, right? And could you have underwrote that same investment when you saw it and saw something that you didn't see, right? And that like
mm.
postpartum I think is like extremely important, and I think in most cases it's not really done. And so what LPs tend to do is say, well, multifamily sucks, like let me go somewhere else.
Yeah.
um uh and I just like, you know um I'm forgetting the phrase, but like I think the definition of a smart person is not a person that doesn't make mistakes, but they perhaps they make smaller mistakes and recover and learn and iterate, right? Which is why like investment sizing is really important, but also learning from anything certainly massive, but also any small lessons as well. You pick up on those, and over time it'll really compound.
I would tell you that I think there's a lot of operators out there that just got caught with the expenses going up, inflationary situation, the, the taxes, insurance, all of that. And then with the interest rates staying high, there was no historical data on that. What do we,
Yep.
we all thought it was going to drop. So to really force and say that these operators are bad doesn't make a lot of sense in my mind. How are you negating that with some of these folks? I mean, you really need to kind of start to pick out the little details
Yep.
that you can't really change at this point.
Yeah, I mean, I think the most simple example is I've had numerous calls that go something like this. They say, I'm pretty sure that there's some sort of fraud or something fishy going on. Like I invested 5 years ago, 4 years ago, 3 years ago, and I just got 70% of my money back. And I like, you know, I'm like, okay, go on, right? And as I continue hearing more and more about the story, I'm like, you should be very happy
Very
that you got
happy, right?
70% of your money back. you know, and
Absolutely.
again, part of that is as you said, like, the best economists can't predict stuff. If you look at sort of like future expectations on SOFR and all these like rates,
Yep.
cap rates, everything, like no one has any idea what's going to happen to some degree. I think there is a certainly expectation from a GP to sensitize deals and understand what could go wrong and how to mitigate for it to the extent that you can. And I always tell LPs, if you can't find like three different ways that your deal will go to zero and not get comfortable with those, like you probably shouldn't invest, because I don't think you understand the investment. Every single deal can go to zero, and many times LPs will tell me like, "Oh yeah, like no, I don't." The worst thing that can happen is I'll get my money back, right? And that's just not true. You can tell me the probability of losing everything is 5%, but you can't tell me that it's zero.
Yeah. So in this market now, where we have a lot of deals that are trading, the A's are trading at below what they owe. Do you think that this is going to be the next couple years, the opportunity for investors as general partners and as limited partners to be able to take advantage of this basis? And should we be jumping in now where we think we're at the bottom? We think, getting a deal is, we're at the deal's time right now. Do you think it's going to be lower? Do you think it's going to continue to go down? Should we be waiting on the sideline?
Yeah, I would say I'm starting to see interesting stuff. Um, but you have to do it very like you have to enter the space very cautiously, and I'll tell you why. Um, I think a lot of LPs don't understand like a very simple principle, which is the reason why valuations got so high, right, in terms of like purchase prices, was because of the expectation that debt is very cheap. And it was. At the time, debt was very cheap. And so
Yeah.
at the end of the day, if you think about the valuation of a property, it's basically like I'm going to assume some sort of thing for NOI, right? I'm going to then subtract some debt service, which at the time was very cheap, right? And then I need to get to some sort of assumptions, right, around the cash flow to investors and the exit value, right? So um, that has changed a lot, right? Meaning, if you look at a property today, and the pitch is basically like, hey, in 2022, actually, this I see this all the time. Like, you look at a deck and it says, this is the lowest comp in the past 5 years in terms of price per door, let's say. And my only answer to that is like, obviously, like it has to be. Meaning, how can you tell me that it's not the lowest comp? Like, meaning the question should be, are there going to be lower comps? And it's not low enough, not whether it's lower. Like the comps are going down by definition. That's what happens, right? But the question is, are you like, so to speak, catching a falling knife, and they're going to continue to go down? So that's where I think this is very intricate and difficult, because on the one hand, yes, there's like some amazing, I'm going to put it in quotes, discounts relative to
Yeah.
2022. But the reason why I say quote unquote is because the question is it really a discount? Or was it just worth too much beforehand and now this is a fair price?
Right. Absolutely. That's the question that we're looking at. And so when you're talking to LPs and they're looking at a deck that says, hey, we're going to be a 20 IRR, how do you really think that that's what they were telling us 5 years ago? And we did see some things 5 years ago at 20 IRR. Where's the market today? What is the realistic returns? How are you underwriting those? How are you analyzing these deals? How are you, and what are you telling your people that show up um, to discuss these things?
You're not going to like this answer, but I tell them not to use IRR.
It's what? Do not use
um,
IRR. I agree too, but go
yeah,
ahead.
in
Yeah.
fact, I think I have an article called uh, 1 second. Uh, Find it. Yeah, there it is. It's called filtering using IRR on cash and cash is dangerous. And there's a bunch of examples as to why I think that's the case. I'll pop it in
Okay.
here so you guys can
Yeah,
take a
that's
look. But
great.
um, basically, the premise is like this. I'll sort of summarize the article for you guys. Um, the premise is the following: that like the idea behind filtering in general, right? Like, should you have a floor to an IRR? Yeah. Like if you get a deal across your desk that's like 9%, you're like, well, I don't know. Like I can get like a risk free at 4% in
Sure.
Robinhood or wherever. Stock market generally, let's forget about the past 2 weeks. Can do like 8%, whatever, right?
Yeah.
On a long term. And it's like, well, like, am I gonna place my money into something illiquid and spend a bunch of time doing diligence while, you know, like the answer is probably not. Now
Yeah.
here's the problem on the other side. Like many people will look at a deal and be like, 10% IRR? Like I saw 20% yesterday. This is crazy.
Yeah.
Like trash. But the problem is like some GPs are very conservative, which I think they should be, right? Like their job fundamentally is under promise and over deliver, right? And so the best thing they can do is tell you that it's going to be 12% IRR and set your expectations there and then deliver much better returns, right? And so that and the same thing again, cash on cash is the same thing. Like people tend to filter for those things, and if you were getting 100 deals a day, like some people are, then
Yeah.
fine. Like you definitely need to deploy, so to speak, some sort of filtering mechanism because you just can't like look at everything. But if you're looking at one deal a day, which I think is the most LPs, maybe even less, then I would be very cautious about using either metric. For the reasons stated, but also they're just like so easy to manipulate, which I also go through that in the article.
So cash on cash, what are you encouraging these LPs to be looking at? What are the levers
Whatever
that
they
you're
want,
saying?
whatever they
L
want. In
cash
other
on
words, like
cash?
yeah, like I just remind them that like if you're trying to find cash on cash investments, overall returns directional will be lower, right? Like generally speaking, if you're trying to like optimize for overall returns, cash on cash will be lower because there's like value that you need to add and therefore there's risk and less cash in the immediate term, right? But then there's like a pop at the end. If you're of the mindset that I don't want to take that long-term risk, an exit risk, and I just want to cash flow day one, no problem. And for example, like on my platform, when an LP joins, they can put in any sort of cash on cash number. Like they can say, I
Mm.
do not want to get any deals from you unless it's at least 5% year one cash on cash. And I just listen to them. Meaning, I don't tell them anything. Like, if that's your preference, if that's what you want, that's what you want. But don't expect the 6% cash on cash deal to be the best overall return. In general, it won't be. But that should maybe that's just not what they're looking for. You know what I mean?
So are you encouraging people to take a look at only A's and B's, or are you saying and staying away from C's? What are you advising right now?
In terms of classes, like age
Yes.
of property. Um,
Age or just, are you doing heavy value add, core plus?
I mean, personally, I look at everything, right? And I think I don't know. Like I think that's a very healthy investor mindset to understand that a deal could make sense at some level. There's sort of a price for any deal, right? The question is, do you understand what gets you to that? So like, for example, Julie, if I look at a class C deal, I'm gonna underwrite that deal differently than a class A deal. And if I don't see like, repairs and maintenance, for example, with a decent assumption, probably a problem, right? If the class C deal is trading at, you know, class A cap rates, maybe a problem too,
Sure.
right? Like so there are certain things that you look for and understand like this just doesn't make sense, right? But again, I think the only way to the only way to see that at scale is just see a lot of deals. But that's actually like the reason why I started GPLP match at some point is I don't know, to be honest, it was just like I'm writing and telling people what's market. And over time, I realized like just people learn best by seeing. I mean, that's how I work.
Mhm.
And
Mhm.
instead of me telling them that 8% pref and 80-20% split is market, if you don't tell me anything else, I'm just going to show it to you. And if you're getting 3 to 4 deals a day in your inbox, and you keep seeing those numbers pop up, you're like, oh, cool. Like now I get it. you
Yeah,
know.
they're all spaced together. But from a uh, risk potential on Class Cs, you know, it's very risky. And in this environment where people have lost money, in my mind, it's like, well, do you really want to put your money in that
Yep.
vehicle as opposed to going to another something more like industrial where it's, pretty or storage, right? So, wanted to kind of hear what your thoughts were from your investor standpoints.
Yeah. Look, I mean, I guess my stance is it depends. you know, I
Okay.
think does it make sense to go from class C to class A? Like, yes, all else equal, I would take class A all day.
Yeah.
Problem is, class A will cost you a lot more and the cash flow will be less and the returns will
Yes.
be less,
Yeah.
right? And so the question is really what you're asking, I think, is what is the spread, so to speak, between the expected returns of like class A and class C? And does that spread like warrant risking it all, so to speak, on class C?
Well,
right?
I think it's from your position as an analyst or as a consultant is finding out what is most important to that investor, right? And then t helping them target, what
Right.
kind of assets would
Yeah.
be right.
Yeah, and again, I think this flight to quality, so to speak, usually, just in my opinion, is like unwarranted. Meaning, people are like, I had a terrible time in Class C. I'm going to invest it all in Class A, or I
Yeah,
forget multifamily. I hate it. Like, it's not what I want to do. I'm going into industrial. Like 8 out of 10 times, terrible idea. Because
I
you're
love that.
going into a space that you just don't really understand. You typically like probably didn't understand what you did wrong the first time, and you're probably going to make the same mistake again potentially. So like either just recognize that like I need to learn some things from what happened,
Mm, yeah.
and reflect, and maybe you can actually make the case that you should go into Class C again because now you understand
Mm.
that space more, way more than you did before. Um, right. So I'm saying you can really make the argument both ways.
Well, and that kind of is a great segue into how do you vet these sponsors, these three pillars that you speak about, making sure that you've got sponsors, their execution, and their background, right? Alignment of interests. Where do you want to go? How can we get you there? Understanding that from a GP and an LP standpoint, and then the property
Mhm.
itself, making sure that that also the capability and sponsorship is the most important. And I think, the new investors that are coming in now who got burned are seeing the value of those sponsorships. So maybe you could touch a little bit on those pillars, what you really encourage people to do as investors.
Yeah, well, I guess as you said, number one is execution and like the sponsor's background. Number two is alignment of interests, which is really a combination of three things: co-invest of the GP, fees, including the acquisition fee, and number three is like the waterfall, i.e., the pref and the split. So, and then number three, which by the way is last on purpose, is the property itself. And so it might surprise you, like, that's crazy. I'm investing in a property. Why would you put the property last? But I can tell you just from looking at a bunch of these decks, like in most cases, I don't even get to the pro forma. Like it's just so hard to get through like the initial two stages that everything is, um, so hard to trust or so
Yeah.
hard to believe in, that you're just like, well, I'm not even sure that I can spend time on the pro forma. I'd rather move on to the next deal, right? To the extent that you get to it, yeah, of course you should spend time on the property. It's really important. Um, and perhaps in some sense, like how good the property is and the thesis compensates for perhaps, like a higher than market split to the GP, maybe higher than market fees, right? Like you can see sort of how these three pillars play with each other. For example, it might be the case that this is the GP's first deal. And so many people would tell you, like, terrible idea. I'm not touching that with a 10-foot pole. But I can tell you there's many LPs on my platform that are like, I'm here to see those deals. Meaning that they have actually filtered out the deals that have a lot of realized investments, and they have filtered in the ones that have very little because they're sort of trying to find that newer sponsor that is just getting off the ground, and they're being very reasonable about splits. And then the question will be like, well, if someone is brand new and maybe they offer a 90-10 split, and they have 100 grand in savings because they're 30 years old, and that's all that they're literally putting it all into this deal, maybe that's much better alignment than some guy or girl who's worth, I don't know, 50 million and they put a million in, right?
Yeah.
Like, which one is better?
Very interesting. I haven't heard that perspective. I'm encouraged to hear that there are people that want to put their money into the new guy. I think that is fantastic. That was not something I would think in this cycle that people would want to do. I'm really encouraged to hear that.
And I think for what it's worth, um, that usually is the more sophisticated LP, right? Meaning the challenge of looking through deals with no realized investments is you sort of have like less of a backbone to sit on in terms of like the assumptions that were made by the GP. And like you really need to kind of know what you're doing to like sift through
Hmm.
those. But like but again, like the more experienced LPs like love those deals. Any day of the week. Like they would take a guy who has like 0 to 3 realized investments, but very good splits, reasonable assumptions. Like they're investing the majority of their net worth into the building or the property.
Wow.
Over someone who has a billion AUM. This is their like 200th deal. um, and
Yeah.
again, what I'm trying to explore here, I guess, is both are okay. Like you need to sort of like see both worlds to understand which one you vibe with, so to speak. Um, and they both could be the answer for you, right? But the only way to sort of enter into the space is just see a lot of deals and just be like, oh, like I really like this. I really like that. I like this about GP number one. I like this about GP number two. And then, a few months go by and GP number 10 comes by and they have everything you found interesting about GP number 1 through 9. And you're like, hey, that's pretty cool. Like, this is interesting.
What do you think is the most important for people today? Is it communication that they want from these and GPs? Is it returns? Is it re- uh, their experience? What are you seeing as a pretty constant for LPs?
Um, I mean, I think anyone who does not say returns to that question is just not being honest,
Okay.
right? I think, and I would actually argue that an LP who says the answer is not returns might be like even misguiding themselves a little bit, because I think some people might say, well, it's a partnership. Like I met you, I shook your hand, and like I'm just gonna be honest here. Like, yes, that's true. At the end of the day, I can tell you when things go south, like you're not gonna hear from the guy or girl,
Yeah.
right? And so like, um, it's true that it's a partnership, but if they find money somewhere else, money is green, and they didn't need yours, right? And so like again, I think at the end of the day, the number one clear thing for both parties is returns. I know
Okay.
many cases of like terrible reporting, like I don't know, like you invested in a deal, didn't hear from the guy for like 2 years, and then he or she like sent you a check, and it's like 2.5x, and you're like, I'm so upset. Like you never talk to me, but at the same time, like, cool.
Yeah.
Like, how do
Yeah.
I invest again?
Yeah.
In some
True.
cases, right?
True.
In some
Yeah.
cases, people might be like, I felt like I was in the dark that whole time, and I'm not investing again because that was stressful or whatever. Um, but at the end of the day, that is, I don't know, that should be like 80% of a decision, I think. Um, I would also argue like reporting in general is overweighted by both GPs and LPs. The percentage of reports that come in monthly that are actually useful are like maybe 10%. I'm just being honest. Like, I don't really care to see the pictures of like the dog park. I don't really care
Mhm.
to see like the holiday party pictures. It just doesn't tell me anything. Like, if you think about the comparison to public markets, like I can pick up my Robinhood app and tell you, like, I invested into Tesla at X price and now it's Y price. And now exactly what's happening. With
Mm.
reporting, it's usually not the case. Like I invested 100 grand and I have no idea what it's worth until I get a
Yeah.
check at the end. And so anything short of that, anything short of you telling me how my investment is going practically is like actually, I mean, it's directionally helpful, but usually it's not so helpful.
That is really good input. Wow. I think that would be great. Let's open it up to questions in the audience here, you guys. Is there something that you heard that was an aha or a question on this reporting is of interest to me because I think we all think getting pretty things out to our investors makes a difference. Charles, how about you? You're a serial investor. What makes a difference for you?
You mentioned the pretty things. Every time I start getting pretty things, those are the deals that don't work very well because they spend all their time making pretty reports.
Yeah.
Yeah.
I like to see, I do like to get a report. I don't think it's possible for them to tell me what my value is at any one point in time because you can't get a BOV and they don't mean that much every instance. So that's sort of too high an expectation. But I like to see a little chart that gives me occupancy, what we made, what we spent, and some percentages there, and that sort of gives me some confidence that they're paying attention. And I can name a couple of my leads right now that can't find their dadgum email, and that ticks me off. And I've got a series of them that are not paying anything, and I understand that they like to send my money to the bank, and that's fine too. But
Yeah.
and I've got a couple that are complete fails. So it's a sad period of time. Most of them are the bridge loans that
Yeah.
have problems, but a couple of them that don't have bridge loans are problems. So, and I blame
Yeah.
you people and myself for some of those. But let's see, you were asking about reports. But yeah, the fancy reports, when I started getting those, it was downhill.
Yeah. Interesting. Yeah. Is
I'll tell you just, Charles, really fast. I agree that it's a high expectation. Um, and I'm not like large enough voice to force my opinion on anyone, but like I don't think it should be, Charles. And I'll just give you a very simple idea. Let's say you invested in an apartment building. I see Dallas Fort Worth. So let's say let's say you invested in a deal in Dallas and it
Mhm.
was at $200, $200,000 per unit, right, per door. Um, and you get a reporting package a year later, and it's like, oh, like here's the holiday party, here's the dog park, blah blah blah.
mm,
And then, oh, by the way, I just wanted to let you know that a comp just traded next door from us for $100,000 a door. How would that make you feel?
yeah.
Like I probably wasn't going to make much on that one, but
Right. So meaning it is true that it's a liquid, right? And it's true that you can't have like live information by the day. But I think it is not true that you don't have information coming in that can be utilized to understand, like, hey, how is an investment going? And again, like if you bought the property at 200 a door and after purchasing it, values went down to the point where things that are similar are trading at 100 a door. If I'm an LP, I kind of want to know that. The GP might not want to tell you that, but I
well,
would want to
okay.
know that.
I was going to comment that I have seen reports where something that went up nearby, they'll tell me about that, but they rarely
Yeah.
tell me anything that went down nearby.
Yeah.
So
Yep.
that's that. One thing that they could do is, every year they have to send a report to the people that are in 401k or IRAs or whatever it is. And I would love for them to send that to everybody because then we all have sort of a known value for what we've done. But some of them just will not do it. They clam up on that number and won't send it to a person who puts real money in instead of IRA money. So
Yep.
irks me a little bit.
Yep.
I would say, Alexi, that when somebody says it's $100 a door and I'm at 200 and you're spending my money to entertain the neighborhood, that makes me feel like, are we spending our money wisely? That's how it makes me
Right.
feel.
And I'm not even there, Julie. I'm not even there. I'm just simply saying that yes, I recognize that it's not stocks. Yes, I recognize that usually reports don't have it. But but I guess I'm just questioning why not? Right? Like if I'm the GP, I feel like that's super important. If there's a trade that happened next door, I probably should know about that, right? Because that certainly impacts the strategy. Meaning, if I told you the inverse, and like let's say a trade happened at $300 a door, then you're like, well, should I even renovate this place? Like, let's just sell it now. Maybe that's the exit strategy, right? So you should be monitoring that. I'm not saying it's easy, like it's not automated in most cases, right? But but you should know what's going on in the marketplace. And of course, if it's the flip side of that and like things have traded down materially, like again, like just like you run comps on rents, hopefully weekly, or I don't know, hopefully even more than weekly. Why shouldn't it be the case that you just ignore sales comps, which is, I think, the best source of information of valuation?
Well, I have to tell you that we have provided that. And then somebody comes back and says, so am I going to get distributions this year? It's like, do you have your head in the sand? I mean, we bought it at 120. It's now worth 70. We're not, it's, that's not going to happen. No distributions this year. It's
Yep.
not going to happen. So it
Yep.
just blows my mind. You can give them all this information, but they still are looking for the bottom line is where's my money? So I think it's a challenge.
I'll pipe in and say that there have been a couple deals that went completely south. And there are people in those deals that were crying about how that's my last dollar. That's the money I was going to
Mm,
pay for my house. They just have a series of really whiny stories. And I don't mean to say they're whiny that they're too bad, but they really ought to not be in this business.
sure.
They so somebody ought to be telling them, other than saying, yes, I need your money, they ought to be saying, no, you really do not qualify. You don't have the right attitude. You don't understand how it works. Your risk tolerance is not high enough for you to play this
Yep.
game. So
Great.
Yeah, I
Great.
think, Charles, that one of the hard parts in this business is like there's no guidelines. Meaning, I think I totally agree with what you're saying, and any good GP is probably asking those things. I think the challenge is, and I mean, I usually speak to LPs, right? So that's really the side that I represent. So as much as I want to say, yeah, it's like totally on the GP, I just don't think that's true, right? Meaning
Mhm.
it's certainly on the LP also to just be like, well, it's probably a bad idea to like put my entire 401k into a single deal. It's
Yeah.
probably a bad idea to over invest in a single deal. It's probably a bad idea to invest money that I can't afford to lose or need soon. There's all these things that I think are like, I don't know, I don't want to call them common sense. That's like almost um it's common sense that's not common. That's the realities I've realized from, speaking to hundreds of people is like a lot of things that are so obvious to some of us are not obvious to everyone. And I guess that's why I'm trying to educate people 1% at a time.
That's fantastic. I love what you do. Anybody else? Alex, did you had a comment, or John Wells, do you have a comment?
Yeah, actually, I did. So that example with the current value of 100 actually should not really influence however you view your deal. If you properly bought it, even if the current value is 100, you don't know what that deal traded for, and did it have the bridge loan? Did it have completely abandoned GP or something else happen? So it's so you're introducing volatility where you don't really need to, right? If
Mm,
you got a normal sort of reasonable loan that doesn't reset every year and so forth, and it doesn't fluctuate, and you perform your GP performs, you shouldn't like it shouldn't really concern you, at least month to month or even year to year, unless you close to the actual exit plan. That's where you're starting to be concerned. That's all. So that's
Yeah,
my two
interesting.
cents.
I mean, I guess I would disagree very respectfully in that, like, as an LP personally, I would definitely want to know that. And Alex, to your point, uh, knowing that's 100K a door is not enough information. To your point, it could be 100K a door because it was distressed, because
Yeah.
it was like half vacant, because there's assumable debt, right? There's a million reasons.
Yep.
But I think my point is just like, if I'm a GP, I should know about that trade. Number one. Number two, I should probably also know, like, here's why it was so low relative to what I bought. And I think from just the perspective of like transparency between GP and LP, it's not so hard to just be like, hey, there's something that traded 100 a door, but you shouldn't be concerned because X, Y, and Z is just totally not comparable. Maybe you can argue it's not even relevant to the point of like actually mentioning it because it's so not comparable. But my point is, let's say it is comparable. I can tell you those cases are happening today. Like there
mm,
are cases where people are invested in $200,000 per unit properties, and a very comparable property a few doors down
mm,
is trading at 100. But the LPs are completely clueless. They have no idea what's
mm,
going on.
terrible. All right, Todd, you got a question?
I do. Yeah, maybe a comment, follow up on that. It just sounds like Aleksy, and thanks for going through the call today. Very interesting. It sounds like LPs, and as an LP myself, can benefit from uh, many more KPIs to track on the GP side, right? So coming from the corporate world, right? It was very important to have regular one-on-ones with employees on the team very candidly so everybody understood, performance expectations and whatnot. So there were no surprises at the end of the year.
Mm.
It's kind of like that, right? That you shouldn't get to the end of a deal when the LP is expecting an exit payout and be surprised.
Right. Exactly. And I guess that's actually great, Todd. That's great. I probably should have maybe
Mhm.
maybe I should have said it like that. In other words, what are fair KPIs from the perspective of an LP? I'll tell you a few. Like you told me that NOI is going to be $1 million after a year, was it? Like, how are you doing against your own expectations? I'll tell you, from the porting packages I see, it is actually it's somewhat common to have a budget, but it's extremely uncommon to have that budget tie back to what you were shown. I don't know why. It's to me, it's like the craziest thing. In other words,
And that,
if you told
and
me
that,
that year one is going to be X, show me how things are going against that X, and if there's any discrepancies, explain it. Right?
yeah,
But again, extremely uncommon practice. I can't
but
tell you
it's
why.
typical at least in the companies I worked at to show, budget versus actual over the long term, favorable and unfavorable
Yes,
trends
yeah, that's
to
exactly
be
what I'm
very
saying.
candid.
But it's like I don't know, how many deals that you guys are in, but like think about your deals and tell me, at the end of year one or maybe at the end of the first quarter or whatever it is, what percentage of your deals did you get like a very clear report of like, hey, remember in the deck that we showed you that first year was expecting 1 million NOI and X million in revenue and so on and so on. Here's how we actually did, and here's an explanation of what happened in good ways and bad ways. I can tell you from the reporting packages I've seen, it's like probably 10%. It's probably 10%.
That's a great piece of information. I like that. Todd, great point. Moses, what do you got?
Hey, Julie, I think one of the best takeaway, Alexi said tonight was when the spreads were going from a C and it's hitting like a 50 basis points and people were just going crazy and not realizing the risk that they're taking on and the return on cost to get a C property to give you a return and all these, excellent IRR and multiple. I think that's where folks kind of lost their fundamental and not de-risk themselves properly. They should have at that point either choose a higher class of property. I mean, I've done some, and I have some in Houston now, and they're
Mhm.
doing. And I think he just touched based on it. Go back and look at your performer. How did the GP said it was going to perform on year 3, 4, or 5, and how are you off from your performer? Because I'm going to exit probably later this year, and it's going to be on point where we decided as a group that it was going to exit, and cap could be 6 or it could be better. We'll still be making money. So I think those are some of the fundamentals that kind of like went by people's head and they didn't pay attention.
Yeah, really good points. I really appreciate that. Well, Alexi, thank you so much for being here and pointing out some of the really important details about being a GP and an LP. I think we hit a lot of both from a operation standpoint, but also from an investment standpoint, and really helpful for so many people listening here. If someone wants to get a hold of you, I know they can reach out to you on LinkedIn. Um, is that the best way, or go to your LPGP match?
Yeah.
GPLP match, sorry.
I just sent my email. I'm very open. Like you can reach out
Okay,
to me anytime.
Alexi, let me just spell it for those people that don't get
Oh yeah,
the
sure, sure.
chat. It's Alexi, Aleksey at Centrio Capital, Centrio Capital.com. So
Yeah,
Alexi, this was amazing.
I'm very active on LinkedIn, Twitter, blog. Like I'm generally pretty responsive. However you reach out to me, whatever
Yeah.
the
Yeah,
easiest method.
I'm currently looking at Lexi's subscription plan, and it's basically $10 a month, 20 $12 a month to have his basically see all of his podcasts and have looks like pretty direct access. So I mean, that's
There's like 100. I honestly lost track, but I think it's like 120 articles.
articles,
Hypothetically, you could pay
podcasts.
$10 and read all of it in a month and unsubscribe.
Yeah. I mean, how,
More.
so how many hundreds or millions of dollars, hundreds of thousands or millions of dollars are you saving by spending, $12 a month by learning, this is a great time to
not
learn.
much. Yeah, it is. It is the right time to learn. So,
Yeah.
well, thank you so much.